I worked in the stock market for 8 years in my job as an analyst, and after that, thinking that I should be doing some more meaningful work in life, I quit my job and actually became a teacher of value investing. So the idea now is not just to help people learn how to make money in stock markets, but more importantly, how they should not be losing money, which is rampant. Talking about stock markets, I am reminded always of a story of Albert Einstein. We all know Albert Einstein. So Einstein was, when he got his first job as a professor, as a lecturer, he was taken by the dean of the college to meet the staff members. And the dean said, "This is Mr. Albert Einstein, your colleague, and he has an IQ of 180. And Einstein said, "Well, that's wonderful. Let's talk about mathematics and physics." Suddenly, a guy from the crowd, from the staff members, came out and shook Albert Einstein's hand, and he said, "I'm also a teacher here, but sadly, I only have an IQ of 80. Einstein smiled and he said, "What do you think where the stock markets are headed?" So, if someone asks you this question, this is a very prominent question that gets asked often, where's the stock market headed? You know that the guy has an IQ of just 80 and not 180. So, talking about successful investing, I think it's a long path. It's not really a gratifying thing instantly, right? You need to put in the hard work, and this is what I've learned over 15 years, that you need to have that utmost amount of patience if you really want to do yourself well as an investor. So the topic which I was given was actually very clear, something which I've been practicing for a long period of time now, 15 plus years, first as an analyst and as an investor. Before I start, it's very important to give you a disclaimer, because a lot of people are expecting a lot of things, and Buffett said, the key to happiness is only one thing. What is that? To have lower expectations. To start off with a disclaimer, standard disclaimer, I must not be solely held responsible for anything you see here today, as my kids have learned to work on the PowerPoint, right? So please don't blame me for everything that you see today. So I start with a story, November 29, 1940, when the Colin Daily Sun newspaper in the US reported of a suicide which happened the previous night. And they reported that there was a speculator who committed suicide and died, right, instantly. This is the final letter that that guy who committed suicide wrote to his wife. He said, "My dear Nina, can't help it, things have been bad for me. I'm tired of fighting, can't carry on any longer. This is the only way out. I'm unworthy of your love, I'm a failure. I'm truly sorry, but this is the only way out for me, love, Laurie." And this guy went to a party the previous night, and he actually hinted about his act of suicide the next day. When a photographer asked him, "Can I click your picture?" He was a very famous guy. And this guy said, "Please click my picture, because it's the last one that you'll click, because I'm going for a long, long time tomorrow." Jesse Livermore, the world's best speculator ever known, he did very well for himself, but sadly he got bankrupt 4 times. The 4th time he committed suicide. At the time of his suicide in 1940, his assets were valued, and he had an asset base of $10,000 only and a liability base of $360,000. Right? So when you have assets much lower than liabilities, what happens? You are bankrupt. And just contrast with the 1929, just 11 years back, this guy had actually earned $100 million. It was not his net worth. He earned $100 million when the Great Depression struck. He was shorting stocks. Right? We all know about buying stocks. There's something called as shorting stocks, when you buy stocks, when you sell stocks to buy it later when the prices are lower. And this guy actually shorted stocks. The Great Depression caused the stock prices in America to crash, and he got rich by $100 million. 1940, 11 years later, he committed suicide. One of the best books that I've ever read in terms of optimal performance, in terms of how do you need to do the hard work to reach the top of the world, is No Shortcuts to the Top by Ed Vistiers. Ed Vistiers is an American, and he chronicles his journey of 16 years climbing all the 8,000 plus meters peak in the world. He was among the very few people in the world who's done that. All 8,000 meters plus peaks in the world. And he talks about the story, the sad death of 2 of his close friends who actually took the risk of climbing the Mount Everest in the evening. Right? He said it's very dangerous to climb the Everest or any peak in the evening because you have to come back. right? And this is a very famous quote that he mentioned: getting to the top is optional, getting down is mandatory. So there was an instant that he talked about where he was just 300 meters or 300 meters away from the peak of Mount Everest, and he asked his entire team to come back because it was evening. He was forcing an avalanche to come, and he actually came back. His team came back disappointed, but they survived to climb the peak again. And he did it several times. So getting to the top is optional, getting down is mandatory. Of course, Ed Vistius knows about it, right? But Jesse Livermore probably did not know about it. He went to the top, but he did not know how to come down. And this guy, we all know as Charlie Munger, one of the best investment thinkers worldwide, has almost similar saying. He says, all I want to know is where I am going to die, so I will not go there. If you know what can kill you, please don't go there. That's the simple secret of succeeding in investment world or anywhere. If you know this thing can kill you, if you know this thing investment can hurt you financially, right, in the long term, in the short term, please don't invest there. As simple as that. Jesse Livermore. So this is a short story of how it happened. In 1929, he shorts the market. He earns $100 million wealth. He goes long again, but the market keeps falling. He loses 40% by mid-1932 of the 100 million that he earned. In end 1932, he again shorts again in the market, and the market doubles. So when you short and the market doubles, you lose a lot of money. And 1933, he goes long again, and this time the market falls. Everything which he earned turns to ashes. And the biographer of Jesse Livermore, Tom Rubithan, in his book, he says, it was a period of total inconsistency and illogicality during which, by his own rules, he should have been out of the market. But he wasn't. Having conquered the world, he wanted to climb again. Getting to the top is optional, getting down is compulsory. This guy did not really remember that. And Livermore himself says he himself said after his third bankruptcy, and he went bankrupt the fourth time when he committed suicide, he said, no price is too high to be paid for a speculator to learn that which will keep him from getting the swelled head. What's a swelled head? You become arrogant. A great many smashes by brilliant men can be traced directly to the swelled head, an expensive disease everywhere to everybody, but most importantly to people on Wall Street. It's rampant out there. People get swelled head. They make some money in the stock markets, they get arrogant and they lose everything, and this is what happened to him. This guy understands the important concept of swelled head very well. Warren Buffett, he's compounded his wealth like hundreds of thousands times over the past 50, 60 years. With an annual rate of return of just 20%. Of course, 20% over 60 years is like huge amount of money. But a lot of people try to do that. A lot of people try not for 20%, they'll try for 40, 50%. Now look at this chart. If you assuming you compound your wealth for 20% every year, right, for 25 years, every 100 rupees or 100 ringgits become 9,500 ringgits in 25 years at 20%. Right? But if you compound your wealth at a much faster rate, 30% every year, much faster than the first guy, but you lose 50% in 3 of those 25 years, you are much below the first guy. So losing money is not a choice here. Of course you lose money because the markets are down, but I'm talking about losing money permanently. Be sure that you are taking investment decisions in a way that you don't lose a lot of money. Right? Things happen. So just to give a few examples of how people behave in the stock markets, is an example of Rain Industries. It's an industrial company in India, and some of the ways people think and lose money. So a lot of people bought this stock, a lot of retail investors, people like you and me bought this stock thinking a big investor from America has bought this stock, how can he be wrong? Right? And this guy was buying the stock at the lows, and then when people were buying in hordes, that the stock price was moving up, everyone was getting richer faster, and then all hell broke loose. And this is how it happened. People lost all their money. People who invested their life saving in these stocks did not survive. They may have gone bankrupt as well. Right? Just one example. Another example, this time is different. The 4 most dangerous words in investing is this time is different. Right? We saw in 97, we saw in 92 in India as well, we saw in 2000, we saw in 2008, this time is different, no time is different. Only the participants change. The behavior of humans, our behavior as investors does not change at all. People lose a lot of money, see? Suzlon Energy, a leading wind power company in India. One of the very general thinking, if the stock has gone down this much already, how can it go much lower? A stock which falls from 100 ringgits to 5 ringgits is down how much percentage? 95%, right? 100 ringgits to 5 ringgits. The other way to look at it is the stock first fell 90%, then fell another 50%. Right? How much can it fall? People say, how much can it fall more? It can go to 0. A lot of big companies, Citibank went to 0. Right? So And the second thing is, if the stock is only 10 ringgits or 10 rupees, how much lower can it go? It can go to zero. Remember that. The third example of a company which is in construction, Jayaprakash Associates. See, eventually they always come back. Stock prices, bad businesses fall down, right? They come back for a short period of time and people start thinking, see, they always come back. No, you lose money permanently on businesses which are bad. So choose your stocks very carefully. You need to understand what's a good business, and that's the reason Pauline talked about the first rule of investing: high quality businesses, high quality managements, a right price, 3 core mantras of investing sensibly. India is one of the biggest real estate companies in India, Unitech Limited. You can always tell when a stock hits a bottom. No, you can never tell when a stock hits a bottom till it's zero. That's the bottom. Not at $10, not at 50 rupees, not at 100 ringgits. Right? If the stock has crashed by 90%, it can crash by another 90%. I'll give you some examples. Right? Assuming it's a bad business. Suzlon Energy, coming back to the same example. This stock was one time 400 rupees. Now it's 5.5 rupees. Right? Won't sell till I get my capital back. How many of you have lost money like 50% in the stock market in a single stock? Anyone who's lost 50% in a single stock? No one? Very smart crowd. How many of you lost honestly? Right? Very nice. So you don't need the session. Do I go back? Russian roulette. Example. What's Russian roulette? Russian roulette is when you put a gun to your head and the gun has 6 chambers, 5 of them empty and just 1 bullet. What's your survival rate in the first time you hit? If I were to offer you $100 million, would you play this game with just 1 bullet and 5 empty chambers? How many of you will not play this game? Oh, the rest of you will play this game for $100 million? It's only 1 bullet and 5 empty chambers. The probability of you surviving the first shot is 5/6, which is 83%. And the probability of you dying is only 17% in the first shot. A lot of people play such games because the probability of success is huge. But what's the consequence of failure? You become a statistic. And it's not a tragedy, it's a funny tragedy. People will not remember you as a tragic death. Yours will remember as a funny death. A lot of people meet there. Of course, it's tragic for the family. But the question is, why do we play such games in investing? We buy overpriced stocks. We buy businesses which are bad. We buy managements which are bad. Because everyone is buying that. The probability of that stock succeeding is high, of course. I'm fine with that. But what's the consequence of failure? It's huge. You die financially. And that's the reason you need to learn what you're getting into. You need to know what you're getting into. You need to understand what are the stock markets, what's value investing, and why does it work, and what does not work in value investing, which I'm sure you're going to learn over the next 2 days. Peter Bernstein wrote a very nice book called Against the Gods, and it chronicled the journey of, or the story of a fund called Long-Term Capital Management in the US in the late 1990s. The only long-term in this fund was the name. They were all speculating in government's bonds, US bonds, Russian bonds, all different kind of bonds. And this guy said, survival is the only road to riches. Let me say it again. Survival is the only road to riches. Know what can kill you. Please don't go there. You have to survive. The only way to be successful after 20 years in investing is to survive. If you survive, you will be richer by 20 years later or 15 years later. But if you get yourself killed, you become a statistic like the Russian roulette. So, instead of talking about the path of successful investing, I think the core mantra of successful investing is surviving, and I'll talk about the 5 important lessons which I have learned in my career of 15 years as a stock market investor and a teacher. The first thing is you need to practice humility. People who are trading in and out of stocks, people who are borrowing money to invest in stocks are not humble, they are arrogant, they think they can do anything and they can still survive. No, it doesn't happen. We've heard horror stories, I'm sure you must have also heard stories of people around you who borrowed money, who traded, who speculated, who did derivatives and lost everything, even their houses and their reputation. And this guy, he himself said, swelled head and expensive disease everywhere to everyone, but particularly on Wall Street. And particularly with guys who are speculators. Bertrand Russell, another guy, the whole problem with the world is that fools and fanatics are always so certain of themselves, and wiser people are so full of doubts. You have to be doubtful. You have to be scared when you're investing. Of course, not scared to invest, but you have to be very cautious. You have to have your doubts whether the investment I'm making is right or not, whether the stock I am buying is making or right or not, whether I am going to survive after 20 years or not, whether the stock which I'm buying is going to kill me permanently. The risk in investing is not to lose your money 20, 30, 40% down because the markets are down. The real risk in investing is to lose your money permanently and not get it back. That's the real risk. Stock price volatility or stock prices jumping up and down is not risk. That's a risk for the guy who's appearing on television, but not for you. So I started my career in stock market in 2003, unfortunately after doing an MBA. So when you're an MBA, you already have a swelled head. You know that you are overconfident, you are well educated, you have done your MBA in finance, and you are now in the stock market. And when I was about to give my interview for the job, before that I watched this movie called The Wall Street. Gordon Gekko plays the lead character, one of the iconic movies on the stock markets. And everyone who's not watched it, please go and watch it. It tells you what not to do. But that time I did not know. I think this was a very smart guy. He said, I don't throw darts on the board. I bet on sure things, which means everything that I buy turns to gold. So I thought stock market was an easy way to get rich, and I'm now getting into the stock market as a career. I'll be much more smarter than other guys, and I'm going to be rich 10 years down the line, 15 years down the line. I thought stock markets were rational. I thought that time that people working in the stock market was rational, and I being a serious rational guy, this was what I thought that time. I would make a lot of money over there. And this is exactly what happened. April 2003, when I joined the stock market as a career, the BSE Sensex, the index, the leading index in India, was around 3,000 levels. And I joined in April 2003. That was almost the start of the next 5 years of bull run, the biggest bull run India has ever seen. From 3,000 levels, the Indian stock market index moved to 21,000 over the next 5 years, till January 2008. So I thought Mr. Gekko was right. Everything you buy turns to gold. Right? And then the revolution happened. That was the peak, January 2008. And when you're an analyst working in the stock market after an MBA, and for 5 years everything that you've recommended has moved up, you think you are master of the universe. You are not master of the universe. And this is what I thought in January 2008. Of course, I was not working with a broker, I was working with an independent research company. So our only task was to write reports, research companies, and give long-term recommendations. But if you're in the stock markets, you start thinking you are the master of the universe. And this is what happened. In the next 11, 12 months, the Sensex came from 21,000 back to 8,000 levels. So Mr. Gekko was not right. You don't always make money. Even if you buy the best businesses at expensive prices, you may end up losing a lot of money. A lot of Indian examples. Infosys, India's leading IT company, in 2000, it was trading at a price to earning of 200 times. People thought it's a great business, let me invest. No, if you buy a great business at an expensive price, which is a third parameter which Pauline talked about, you are going to lose money even in the long term. And this is when you realize, as Warren Buffett said, it's only when the tide goes out that you know who's been swimming naked. It's only when the markets come down you realize who was making a mistake. You were making a mistake. People don't accept or don't realize their mistakes when they are making money. But the mistake in investing is not made after you've lost money. The mistake in investing is made the day you made that decision to buy a wrong kind of a business at a wrong price or a wrong management. That's the day the mistake is made. And to ensure that, you need to learn what is sensible investing. You need to understand the 3 core pillars: good quality business, good quality management, and the right price. If you miss any of these parameters, there's a great chance that you are not going to make money in stock markets. But if you fulfill all the 3 parameters, there's a great chance that you will create a lot of wealth through stocks over a long period of time. Let me repeat that. A lot of people become arrogant, so they are not humble. This is like the concept of circle of competence that Pauline talked about. Circle of competence means things that you understand. The red circles are the circle of competence. The smallest one may be the circle of competence that you may have. You understand only, say, 5 industries or 3 industries or, say, 50 companies around you. The analyst may have a bigger circle of competence, and the fund manager may have the biggest circle of competence because they are in the industry. But the size of the circle does not matter. Remember this, the size of the circle or what you know now does not matter. What matters is knowing the boundaries. Don't cross the boundaries. Same in terms of knowledge. People who start thinking they have learnt it all after attending 2 days of workshop or conference, you're trying to fool yourself. Assume an island of knowledge. Assume an island of knowledge which is surrounded by a sea of ignorance. Right? What happens when the size of the island increases? When the size of the island increases, the island of your knowledge, so do the shorelines of ignorance. Which means the more you know, the more you don't know. Or the more there is to know. You need to be humble to understand that the more you know, the more there is to know. But the day people start thinking, I've known it all, that's the start of the downfall. And when you stick with your circle of competence and remember the boundaries, it means you are being humble, and that's a great characteristic to become successful in the long term. Buffett, what counts for most people in investing is not how much they know, but rather how realistically they define what they don't know. These guys have been shouting out these rules for many, many years. Investing is simple but not easy, Buffett says. What is simple if not easy? Simple are the rules. And they are in front of us since 1934, when Ben Graham wrote the first book, Security Analysis, the first edition, 1934. All the rules are there, surviving since 1934 till 2019. But what is not easy is practicing them. Because what comes in between is our behavior. Successful investing is only 1% intelligence and 99% good behavior. So what you are going to learn in terms of financial statement, in terms of how to find good businesses, is only 1%. 99% is how you behave. Whether you are humble or not, whether you are arrogant, whether you have a long-term horizon, how you behave while picking stocks, that's 99%, and you have to train your brain. Of course, our brains are not rational. Our brains are not wired to make rational decisions. We are still surviving in the savannas. We still have that gorging gene that was there with our ancestors. As soon as they saw a tree laden with fruits, the first thing was to eat everything, or try to eat as much as possible before the baboons or the other guys would eat them up. Today's world, even when our refrigerators are filled with fast food, the moment we see it, we try to eat as much as possible, thinking that everything is going to disappear. So our genes have not changed. In the same way, our brains have not really evolved enough to help us make rational decisions. And if we understand, that's the most important thing, we need to understand that we don't know a lot of things. We need to understand the boundaries of our knowledge. And that's the way you start. The second important thing which I've learned is practice inactivity. A lot of people want to just do something. Blaise Pascal said all of humanity's problems stem from the fact that man is not able to sit in a quiet room doing nothing. We have to do something every now and then. And that causes all our problems. Like this example, four Indian companies which have been great businesses for many, many years. And the red bar is the stock price performance between January 2008, when the markets were at their top, Indian markets, till March 2009, when they hit the bottom that time during the financial crisis. Of course, the great businesses also lost money when everything fell down. They fell by 35 to 55%. Right? But if you are holding those great businesses even at the peak in January 2008, and holding on them till now, you would have still made 1000% plus. So ignoring what is going to happen in the world, ignoring whether the markets are crashing, ignoring whether it's a great depression which is coming, ignore that. Focus on the businesses. So from the peak of 2008 till the next 15 months, the stocks fell. But from the peak of 2008 till now, the stocks have still given you 1000% returns plus. These are high quality businesses. On the other hand, you have some low quality businesses. From the peak of 2008 till March 2009, the bottom, the stocks fell by another 80-90%. But people thought, how much more can they fall? They already down 90% by March 2009, when the markets were at the bottom that time. Let me buy again. From the bottom of March 2009 till now, they have fallen another 90%. And these are bad quality businesses. Not in hindsight, they were bad quality businesses even then. So high quality businesses over a long period of time, if you hold on to them till the time they remain good, if assuming you have bought them at the right prices, you're going to make a lot of wealth. It's as simple as that. Following it is difficult. So remember that and try to follow it. Who are the best investors? Fidelity, one of the world's largest fund houses in the world, asset management companies, did a survey among its clients of their performance, its own clients, of their performance between 2003 and 2013. And they tried to find out which of their clients did the best. The second best performers were the guys who forgot they had account with Fidelity. And the best performers were guys who had account with Fidelity but were dead. So when you are dead, you don't call your broker to buy and sell stocks. And your broker cannot call you, sir, can I buy the stock? Can I sell the stock? The market is looking hot and everything. Of course, you don't need to die to achieve great returns from stock markets, but get the idea. You have to be inactive as much as possible. You should not be trading in and out of stocks. You should not be looking at stock prices every day. At best, you should not be maintaining an online portfolio tracker. Please, if you have an online portfolio tracker, of course the application that Pauline talked about has an online portfolio tracker. But the moment you have an online portfolio tracker and you look at the stock prices day after day, minute after minute, you are actually trying to become more stressful. And in that stress, you'll act a lot. When we are stressful, our brain stops working. Anyway, it doesn't work. But our brains stop working and we end up making a lot of mistakes. And this is what happens. The best investors are the dead investors. Think and act long term. Again, coming to Buffett, no matter how great the talent or efforts, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. Some things just take time. Happens in investing. You cannot expect to buy a great business and say, run, run, run. It won't run for you. It'll take time, maybe 10 years, maybe 5 years. It can make you rich in 2 years as well. But there you got lucky. But generally great businesses earn a great amount of return over 15 years, 20 years. That's the amount of time you need to give yourself and the business to run, rather than trading in and out of stocks every month and every quarter. Average holding period of mutual funds in India. 51%, the red bars, 51% of investors don't hold a mutual fund. Forget the stock. Don't hold a mutual fund for more than 12 months. It's more than 50%. The rest are probably sensible. They may not be sensible when it comes to stocks, because look at stocks. The average holding period of stocks. Now this is American data. I'm sure this is applicable to any market. In 1960, the average holding period of stocks was 100 months. If you bought a stock, on an average, people would hold on to that stock for 100 months. In 2010, it was just 6 months. I'm sure when they collect more data, extensive data, it should be rather 6 seconds. Because people are not... 60 seconds is long term for so many people. Look at this data, and this is where you can create an advantage for yourself. When 99.9% of people are trading in and out of stocks, not making money, your advantage is when you extend the time horizon. Not to 100 months, beyond that. Till the time the business remains good, you keep owning it. What's the need for selling the business? What's the need for trading in and out when you know that it doesn't work? How many rich investors do you know of? Among the top richest guys, there are few rich investors. How many few rich traders do you know of? And how many old investors do you know of? Warren Buffett is 88. Charlie Munger is 94. Templeton is 80 plus, 85 plus. John Bogle died recently at 87. Peter Lynch is old. The world's best investors have survived till 80, 90. So another rule, if you practice long-term investing, you may survive longer.